Okay. So you ready? We're going to start this class like every other class with a test. It's going to be about something we're going to talk about today, but I think you already have the ammunition to answer this, partly because if you've taken corporate finance, you definitely have the ammunition to answer these questions. So this is going to be about risk-free rates. I have a question. You're valuing a Brazilian company in nominal Brazilian reais, right? The risk-free rate in reais is 7.5%. The risk-free rate in US dollars is 2.5%. Obviously, set back very different point in time. So a very simplistic question. You have a Brazilian company, you're valuing in reais. The real risk-free rate is much higher than the dollar risk-free rate. In which currency will you end up with a higher value for your company? Harry Greenberg, you want to try?
Yeah, sure.
So I have a choice of value in real or dollar. The real risk-free rate is 7.5%. The dollar risk-free rate is 2.5%.
So the real would
give you a higher discount rate than the dollar. So a dollar discount rate will be much lower than the real discount rate. So the question I'm asking is, will that translate into a higher value when you use a dollar discount rate?
Yeah, so in the real, the US dollar would give a higher rate.
Okay. So you've just given an opening for it. When I value an emerging market company, then what should I always do? Do the valuation in US dollars or euros, the value will be much higher because my discount rate is lower.
Yeah.
But am I missing something? This can't be right? Because then I can make any company worth any number. I'll value every company in Swiss francs. Forget about the US dollar, where I pick a negative risk-free rate. I must be missing something. Emily Glaser, do you want to try? What might I be missing? I know you're reading. I'm sorry to interrupt, but what might I be missing?
You're missing the exchange rate between the currencies.
Which is driven by, in the long term, what drives exchange rates? Inflation. The real is a higher inflation currency than the dollar. And it's true that by using a dollar discount rate, I get a lower discount rate, but my cash flows also have to be in dollars. And if the inflation in dollars is lower than the inflation in reals, guess what's going to happen? What one hand gives you, the other hand will take away. My growth rates will be much lower for the same company in dollar terms than in real terms. So I'm going to make a statement up front, and I'll come and back this up later when we actually do valuations. If you do your valuation right, and it's a big if, your valuation should be currency invariant. You know what I mean by currency invariant? I find your company undervalued when I value it in real. It should stay undervalued when I value it in dollar or Swiss francs. Thank God for that. Because otherwise we're in no man's land. Because if your value actually changes as the currency you pick changes, you're going to be playing all kinds of games. But currencies then convey inflation. That's basically what the role of a currency is, right? Can you take currency entirely out of the equation? In fact, if you do, it's called a real valuation. What's a real valuation? Not a real. I know it's very confusing. A real valuation, when you do your cash flows, you act like you have constant prices, that you're not able to raise prices because you live in a constant price world. There's no inflation. So if you're going to grow, it's got to be from selling more units. And when you do your discount rate will have to be a real discount rate. Now, we've not talked about the mechanics of it, but basically what you do is you take inflation out of the denominator, inflation out of the numerator, and here's the good news. If you do it right, a real valuation will deliver the same value as a dollar valuation, as will a nominal real valuation. So let's talk about risk-free rates. If you look at risk-free rates in the US, they're now at historic lows, right? 1%. Little higher than they were 6 months ago, but still, if you look at the history of T-bond rates going back to the 1920s, this is about as low as 10-year bond rates have ever been. And of course, the culprit, if you ask any investor this, or you watch CNBC, who's responsible for keeping rates low? Tom Catalano? Who's the entity that's kept rates low that we should be praying
Fed.
to every day? The Fed. The Fed keeps, I mean, if I asked you, how many of you believe that? My wager is if you've been reading the papers and watching CNBC, most of us are convinced that the Fed is this supernatural entity that basically sets rates. And I've told this story before, but I'll tell it again. But I remember a few years ago, I took my wife and my two youngest kids on an expedition to the Federal Reserve in downtown New York. They actually run a tour where you can come in. It's free. Actually, it's a great tour if you have family visiting and you want an exciting place to be. Not really, but no, the Fed is, you go into this building and then this person takes you. The best part of the tour actually is when they take you down, they show you the mint, where they show you the currency stacks. And we walk in and I almost made myself persona non grata right off the top, which I tend to do with my family, where this young guide came up to us. She was about 23, 24. She wanted to take us around. I almost asked her the question that got me thrown off the tour. I said, can you take me to the interest rate room? Because if you listen to CNBC, you're convinced it's a room that Ben Bernanke and then Janet Yellen and now Jerome Powell go into, and in that room there must be levers, right? There's a T-bond rate. Let me move that to 1%. Or the T-bill rate looks too high. Let me move that to... The reality is there is no interest rate room. You know why? Because the Fed doesn't set interest rates. What's the only interest rate the Fed sets? What's the only rate the Fed actually physically sets? Yossi Lubin, what's the only rate it sets?
Rate between banks.
It's a Fed funds rate. In fact, that was going to be my second question. Could you take me to that window? I'd like to borrow the Fed funds rate. You know what the guy would have said, right? You're not a bank. You can't do that. The Fed funds rate is an overnight borrowing and lending rate. Does the Fed influence other rates? Of course. And later today in the class, I'm going to talk about how much or how little that effect is. But the Fed doesn't set rates. And often when the Federal Open Market Committee meets, we're convinced that that meeting, everything comes to a standstill on Wall Street. The Federal Open Market Committee meets. What are they going to do? Are they going to raise rates or lower rates? And the reality is they can't do a thing to rates, which is beyond what the market wants them to do. The Fed, I've described as the Wizard of Oz. You remember the movie The Wizard of Oz? When Dorothy and the motley crew she collected, the scarecrow, the lion, etc., show up at the wizard's. You've seen the movie, right? If you haven't, you should. It's a really long movie, so just skip to the end. They all show up in the wizard's room, and they get ready to line up what each wants, right? Dorothy, of course, wants to go back to Kansas. Don't ask me why. The scarecrow wants a brain, a heart, a courage, each one. And they all tell, because they've been told the wizard has the power to give you whatever you want. And anybody who's seen the movie, tell me what actually happens. The curtain drops and they discover there is no wizard. The power of the Wizard of Oz came from the perception that he had power. The power of the Fed or any central bank comes from the perception that it has power. That's a strong statement to make, but we'll come back and talk about it. And finally, let's deal with something that's become a reality that freaks people out, which is that there are some currencies where the risk-free rate has become negative. The euro, the Swiss franc, the Japanese yen. You know why that freaks us out? In your Econ 101 class, when you talked about interest rates, remember how the econ professor talked about trading current consumption for future consumption? Interest rates were always a positive number, right? So when this first started happening 4 or 5 years ago, people started freaking out, especially in the valuation business. Why? Because how do you build to a discount rate valuation? You start with the risk-free rate and you build on top of it, right? You say, can I do that if my risk-free rate is minus 0.5%? I'm going to argue you can, but many people feel uncomfortable with negative rates. So you know what they do? They replace them with a normalized rate. So I want somebody who's had some experience in markets the last few years to be my guinea pig. Zach, you want to be my guinea pig? I'm going to ask you about, the T-bond rate right now is 1%. We'll all agree it's low, right? If I ask you what's a normal T-bond rate, what would you say the answer is? Give me a number. Then you go with your gut.
Let's go 4%.
4%. Now, if I ask Tom Galante the question, I might get a different answer. First, normal is going to vary. In fact, I can tell how old you are by what you call normal. If you say a normal T-bond rate is 6%, you've been around too long because you probably started in the 80s. We heard of frames of reference in behavioral economics, that we all have a frame of reference of what we think is normal. In fact, research shows that what you observe between the ages of 25 and 35 become the basis for normal. So what you think of as normal music, normal interest rates, normal way of doing things kind of gets cemented in that time. Do you see where I'm going? When people talk about normalized rates, they act like there's some consensus. Zach might think it's 4, I might think it's 3, Naeem might think it's 2.5, and Bucky might think it's 7.5. Normal is in the eye of the beholder. So we have lots on our agenda. So here's what we're going to do. I'm going to close this up and let's go back to the package. So we're back in the lecture note package. Let me wait for it to open up. We're going to talk about risk-free rates today. And hopefully by the end of today, we can dispense with a lot of stuff out there that I think is just misplaced. So let me go to, I think we were on defining risk-free rates, right? I left you there. I said, when you talk about risk-free rates, you got to define horizon, you got to define currency. And I said, not all government bonds are risk-free. So here's what we're going to do to understand risk-free rates. I'm going to present you with a series of questions. Don't overthink them. So I'm going to pick on one of you and go with that. You're saying, I don't know anything about interest rates. I don't understand the Fed. You don't need to. Just use common sense. So here's the first one, right? And I'm going to make Jesse Gia be my guinea pig. Jesse, you ready? So here's what we have. We have in valuation, when we think about how we value companies, we estimate cash flows forever. Why? Because if you think about it, even if we stop after year 5, because we assume cash flows go beyond that, cash flows last forever. You need to find a discount rate. So let's say you're doing a US dollar valuation of a company, and I give you a choice of different treasury rates. I want you to just tell me, based on the fact that our cash flows last forever, which one of these you would use as your risk-free rate. So the first is a 3-month T-bill rate, short-term treasury. The second is a 10-year T-bond rate, which is, at the time that I did, this was 0.93%. The third is a 30-year T-bond rate. That's the longest term treasury bond you're going to find. You also have a rate called a TIPS rate. You know what TIPS rate is? It's an inflation-protected treasury bond, where basically if you're guaranteed, it says -1%, you think that's terrible, you'll get -1% plus whatever the inflation is that year. So if you have inflation is 5%, you'll get a coupon of -1 plus 5. Or maybe the right answer is none of the above. So given that your mission is to value a company and you've estimated cash flows forever, do you want to go short term or long term?
Long term.
Long term, because it's a simple duration matching, right? And in fact, if all you had to do was pick a risk-free rate, which of those would be best suited for cash flows in perpetuity? 30-year T-bond, right?
Yeah.
Every valuation you're going to see after this one, I'm going to use the 10-year bond rate. And I'm often asked, why don't you use the 30-year T-bond? Theoretically, there's no good reason. But practically, I'll tell you why I don't use the 30-year bond. The first is the 30-year bond, the 10-year T-bond is issued every Monday. There's always a fresh issue. There's always a 10-year bond. And it's the most heavily traded long-term bond. So you can look 15, 20, 30, but the 10. The 30-year bond actually has a very strange market of buyers and sellers, which can cause it to be off where it should be, because that particular week, you had a strange buyer, a strange seller. That's the first problem. The second problem is, remember, the risk-free rate is the start of the process, right? To get a cost of equity, I need an equity risk premium. To get a cost of debt, I need a default spread. And if I define my risk-free rate as a 30-year bond rate, everything else has to be computed on that basis. So for a default spread then, if my risk-free rate is a 30-year T-bond, I need to find 30-year corporates. Now, do you see why this is going to be problematic? Corporates generally are 10 years. You don't find too many 30-year corporates or 50-year corporates. Every other input into my valuation becomes more difficult. So I'm going to go long-term, but perhaps not as long-term as you expect me to. I'm going to stop at 10 years. And in most other currencies, 10 years is about the limit you can hit. You're not going to get 30 or 50 years. So the answer to the question here is, I'm going to use the 10-year T-bond. Why am I not using the TIPS rate? Prithvi, why am I not using the TIPS rate?
It may not give you the right growth rate there. Like you're trying to factor in.
I gave you, when we talked about the test, I said, if you don't like to deal with inflation at all, what can you do instead? Do everything.
Normalize.
No, not normalize, the real terms. I said you could take inflation out.
Yeah.
You know what the TIPS rate is? It's like a real risk-free rate. If you did your analysis in real terms, you'd build off the TIPS rate. So you can't use the TIPS rate because I'm doing everything in nominal terms. So it's nominal terms, I need a nominal rate, and I'm going to go with the long-term rate, in this case, the 10-year rate. But while I'm doing all of this, I should get down on my knees and hope and pray that what's true. What did I say risk-free rate has to be? There can be no default risk. You see why I have to pray? Because I can't assume the US Treasury has no default risk. We flirted with default on the US Treasury before. If you remember, in 2012, I think S&P actually downgraded the US from AAA to AA+, which is essentially a signal, hey, there could be default risk in the US Treasury. I know that the chances are very low, but when I use a Treasury rate, I'm implicitly assuming that there will be no default. So I will use the 10-year T-bond rate, but I'm not going to do it casually. I am making assumptions, might as well be explicit about them. Any questions about, yeah, go ahead.
Yes, so in countries like Greece that have been defaulted,
yeah, I'm going to come to you. In fact, we're going to come to that because you're raising a very interesting question. At least with the US, we can debate, is there default risk or not in the government? In the case of Greece, that question doesn't even get asked because, let's face it, asking whether there's default risk in Greece is kind of of course there is. The question is how much. And if there is, the question is how do we clean up for that? I'm going to come and give you a chance to actually work through countries like Greece, like Brazil, like India, where you can argue that there is default risk in the government bond that you have to clean up for. Let's move to the second question. In fact, Yossi, I'm going to put you on the spot because you brought up a Greek company. And Greece, of course, is now part of the EU, and the currency is the euro. So let's say you're valuing a Greek company. Are you valuing a Greek company for this class? No. No? Okay, let's say you're valuing a Greek company, Titan Cement, well-regarded Greek cement company. You've decided to do the valuation in euros. Why? Because all the financials are in euros. You need a risk-free rate in euros, and you go looking for a government bond denominated in euros. You have a luxury of riches because you have this graph, at least 10 different governments, all issuing 10-year government bonds, all denominated in euros. But you have a problem. The rates are all different. So I have a question for you. If you're valuing a Greek company in euros, which of these rates would you use as your risk-free rate?
I would say Greece. But...
If you use a Greek bond rate as your risk-free rate, I'm going to confront you the question of how can it be risk-free if you have other bonds in the same currency. The only reason the Greek bond and the Spanish bond or the Italian bond have higher rates is because there's default risk embedded in them, right? They're all in euros. This is in 1997. We're not talking about drachmas and francs. We're talking about euros. The only reason for difference in the rates is because the market perceives more default risk in Greece and Spain and Italy than it does in Germany and the Netherlands.
Oh, so you want to use sort of a default-free...
which is, in this case,
right,
it's staring at you right. I'm going to use the German euro bond rate. When I did this session in Greece a few years ago, and I said, I'm going to use the German euro bond rate. Once they got over the nationalistic thing of how dare you use a German risk-free rate on us, you know what they wanted to do? They said, but we're a Greek company. We should be punishing the company for being Greek. Why are you giving them a risk-free rate that's a German euro bond rate? Because the risk-free rate is not the place I will punish you. There's a place I'm going to come back and punish you for being a Greek company. The risk-free rate should not bear that burden. So let's make this very simple. If I'm valuing a Brazilian company in US dollars, what should the risk-free rate be? The T-bond rate. If I'm valuing a Russian company in British pounds, it should be the British pound risk-free rate. Risk-free rates are driven by currency. It's not the place where you punish a company for being in a risky part of the world. So if I were to value a company in euros, in fact, there are people who actually argue that even the German euro bond rate is not purely risk-free because the German government actually can't print as many euros. The minute you turned over your currency to a common currency, you've lost the capacity to print as much currency as you want. So there are some people argue you should use the ECB. ECB has bonds out there, which are 10-year bonds. That rate is very close. So if you really want to go that route, you can. But my guess is the German euro bond rate is a pretty good proxy for a risk-free rate in euros.
So what about a country that doesn't using the current currency like Russia, ruble, or Brazil? What do you do here?
You're just one step ahead. Let's talk about India. It's not Indian government. Obviously, the Indian currency is the rupee. And on January 1st, 2021, the 10-year Indian government bond rate in rupees was 5.92%. Josh Gilly, you're on the docket here. Okay? So that's my government bond rate. I want a risk-free rate in rupees. What's my first stop? I want to check to see if the Indian government has any default risk, right? I want to make sure. So I could do some research, but let's face it, I don't have the time for that. So I'm going to cheat. Here's what I'm going to do. I'm going to go to the Moody's website. And if you know, Moody's has sovereign ratings for countries. Basically, it rates every country. And in fact, there's two ratings for every country, a foreign currency rating and a local currency rating. The foreign currency rating measures the default risk that Moody's sees when India borrows in dollars or euros. The local currency rating is the default risk that Moody's sees in India when it issues bonds in rupees. What will make my life really easy? What would I like to see as the local currency rating for India that will make my life easy? If Moody's tells me there is no default risk, a AAA rating. That's what I hoped I would find. But it turned out that India is rated Baa3. Not bad, but definitely not AAA. Now, I know I'm trusting the ratings agency here, and that's a dangerous thing to do. But if you trust that Baa3 rating, it turns out that the default spread in early 2021 for a Baa3 rated sovereign bond was about 1.95%. So Josh, I'm back to you again. Right? So the government bond rate was 5.92%. But India has some default risk, and based on my judgment, that default risk is translating into a 1.95% default spread. Can you help me and give me a risk-free rate in rupees? What would I do? Just to mute, go ahead. Yeah.
You'd add the risk, add the default spread to the risk.
Would I add it or would I subtract it? Remember, the 5.92% is a government bond rate. The government bond has default risk in it. So if it already has default risk, the 5.92% is too high because it reflects a default risk in there already. I want to get rid of the default risk. I want to subtract.
That's a compelling case to subtract it instead.
There you go. So I'm glad I convinced you. So the risk-free rate in Indian rupees is going to be 3.97%? 5.92 minus the 1.9. Some currencies are more work than others. But just because you have a government bond rate doesn't mean it's risk-free. That rate reflects some default risk. And there are currencies like the Zambian kwacha or the Nigerian naira, where the rating is so bad that the default spread you subtract out will be a hefty chunk. And you know why I want you to do it? Because if you don't do it, I think you'll end up double counting risk. I know this is not fair because I'm the one who makes a claim, but why do you think I'll end up double counting risk if I leave the risk-free rate in rupees at 5.92%?
I'm
You
not
can
sure.
pass if you don't.
I'm not sure. Yeah.
Anybody want to try? If I leave the risk-free rate, if I call the rupee risk-free rate 5.92%, I'm making the claim that I'm probably going to end up double counting risk. Anybody want to help me on why that might happen? So I start with the risk-free rate of 5.92%. Fill in the rest of the story. What do I do to get a cost of equity for an Indian company? I start with the risk-free rate, then I take a beta or betas, and I multiply by an equity risk premium, right? And what will that equity risk premium look like for a country like India? It's going to be higher because it's a risky country. You see where the double counting happens? Because now I have counted country risk twice. Once by using the 5.92% as my risk-free rate, because that already has a country risk in it. And then on top of that, adding an equity risk premium because it's a risky country. So it sounds tedious, but that's why I clean up government bond rates to prevent the double counting. So Yossi, I hope that answered your questions. If you're a currency where you cannot find a default-free entity, you got to find the spread and net it out of the currency. Now, of course, this leaves you with the question of how the heck do I come up with that default spread? That 1.95% came out of left field, right? Where do you come up with it? I'll give you three pathways. And if you remember from corporate finance, these were the three pathways we talked about there as well. Here's the first pathway. If your country has dollar-denominated bonds outstanding, you can get the default spread for your country by netting out the T-bond rate from it. I'll give you an example. Getting a default spread for any Latin American country is usually easy because almost every Latin American country issues dollar-denominated long-term bonds. The Peruvian government, for instance, does it. Let's say a 10-year dollar-denominated Peruvian bond has a 3% yield to maturity. The T-bond has a 1% yield to maturity. 3 minus 1 is 2%. There's a default spread. But for this, you need dollar-denominated bonds or euro-denominated bonds issued by your country compared to something risk-free. The second choice is something we wouldn't have had as an option 20 years ago. You've heard of the sovereign CDS market. Sovereign CDS market is an insurance market. If you have a bond issued by the Brazilian government, you're worried about default. The sovereign CDS market is a market you can go to and buy insurance against default. So it's like a market estimate of your default spread. There are about 72 countries with a sovereign CDS spread. You can look up the CDS. It's a market set number. Could it be different from what you got with approach one? Absolutely, because the market's constantly reassessing what's happened in the most recent past and bringing it in. And markets are also volatile. So you could use a dollar-denominated bond or a euro bond to get the spread. You could use a sovereign CDS market to get a spread. Or if neither of those work, you can cheat. If you have a rating for your country, like I did for India, you can estimate what a typical spread is for countries with that rating because I have that data for other countries as well. So if you tell me you're Baa3 rated, I can find other countries with Baa3 ratings which have either sovereign CDS or government bonds, and the typical spread is 1.95%. So let's try this out. Let's assume we're trying to get a risk-free rate in the Brazilian real. So if you look at January 2021, I started with the government bond rates. Remember, these are not risk-free yet. These are the government bond rates in about, I don't know, 20-something currencies, 30 currencies. So these are 10-year government bonds in the local currency. So if you look at the Brazilian real, 7.02% is the 10-year government bond rate. So what do I need? I need a default spread. Here's the first approach. I told you most of Latin America countries have dollar-denominated bonds. Brazil has a dollar-denominated bond. A 10-year bond rate at the start of 2021 was 2.98%. The T-bond was 0.93% on that day. The difference of 2.05% is an estimate of the default spread for Brazil at the start of 2021. Coming from, you can do this only if you have two bonds in the same currency. Don't try this if you have a rupee bond and a dollar bond. It's not going to work. It's got to be in the same currency. Any questions on this? So this, you need a government bond. There are about 25 countries in the world where you're going to be able to find a government bond in another currency where there is something default free. Eastern European countries often have euro bonds where you can compare to the German euro bond rate. And Latin America, you have dollar bonds you can compare to the T bond rate. Here's the second approach.
Professor, I have a quick question
Yeah.
on the
Go
first.
ahead.
So that 2% we got for Brazil, does it matter what currency we're doing the valuation in?
It is. And in fact, I'll come back and talk about it. There is this internal problem, which is almost every default spread you're going to look up there is going to be in either dollars or perhaps if you're lucky in euros. You're never going to find a rupee default spread out there. There is an internal inconsistency, and I'll talk about what to do if that bothers you, because there are some high risk-free rate government bond rate currencies where you might have a problem, but it's the reality we face. Our default spreads are in dollars. Take a second stop, sovereign CDS spreads. Now, if you get to a Bloomberg terminal and you type in the word SOVR, you get the current default spreads, sovereign CDS spreads for pretty much every country where there's so this is the most updated number I got, start of 2021. Let's take Brazil. 2.15% is a sovereign CDS spread. Now you're saying that I've got my default spread, I can move on. There's one little issue with the sovereign CDS market that has continued to trouble me. If you look across the countries, notice something, there isn't a single country in the world with a zero sovereign CDS spread. Not one. And that can't be true. I mean, you're telling me the Swiss government is going to default? What that effectively also tells you is the sovereign CDS market is a market with frictions. Like what? I mean, you can face the risk that, you're buying insurance, your insurance is only as good as the insurer behind it. You might be exposed in a sovereign CDS market to insurers defaulting. You could have market frictions. That's my explanation for why no country has a zero default spread. So I'm going to cheat. I'm going to say that 2.15%, most of that is a default spread for Brazil, but some of it reflects these frictions. And if I can somehow clean up for those frictions, I'll get a better estimate. Now, the spread that I got for the US was about 0.23%. That was a sovereign CDS spread. I said, you know what, that 0.23% that I'm getting as a spread for the US is really not for default risk, it's for these frictions. So I'm going to reduce every single sovereign CDS spread that I get out there by 0.23%. If you don't like my logic, just stick with the 2.15%. It's close enough and I'm okay with it. But I removed the US CDS simply to get a purer measure of what the true default spread is. So let's see where we are. With the government bond, dollar-denominated bond, the default spread I got for Brazil was 2.05%. With the sovereign CDS market, I'm getting 1.92%. There's a third way I can get a default for Brazil. Brazil is actually a BA2 rated country. It's actually slid in the ratings in the last 6 years for a variety of reasons. The default spread for a BA2 rated country is about 2.65%. So three measures of Brazil's default spread, right? 2.05% with a dollar-denominated bond, 1.92% with the sovereign CDS, and 2.65%. You're saying, which one should I use? I'm going to say something incredibly weird, but I'll back it up later. Use it, whichever one you want, as long as you stay consistent. This default spread, if you think about it just as a number you subtract out to get to a risk-free rate, the larger the default spread, the better, right? Because you end up with a lower risk-free rate. So if I use the 2.65%, my risk-free rate is only 4.47%. Or it should really be 4.37%. But if I use the smaller spread, my risk-free, so you're saying, I'm going to go with the larger spread because it gives me a lower risk-free rate. Okay? There's another place I'm going to come back and ask you for this default spread. You know where it's going to show up? When I do your equity risk premium. If you pick a high default spread here, it's true, it'll lower your risk-free rate, but it'll also push up your risk premium. So what I'm saying in a long-winded way is don't waste too much time trying to pick the right spread. If you want to average it out, average it out. If you want to use one, use one. But stay with that judgment all the way through in computing your cost of capital. So as everybody comes through the mechanics, start with the government bond rate cleanup. And if you clean that up, you're going to end up with the risk-free rates, at least for those currencies where you have a government bond. As I said, you always have the option of completely evading the currency issue and doing everything in real terms. So I gave you the TIPS rate. Let me go back to start of 2020, when the TIPS rate was actually 0.4%, because the negative interest rate is something I don't want you to confront right now. TIPS rate was 0.4%. That is a real risk-free rate, not just in the US, but globally. But to make that statement, I have to add a condition. If capital can move freely across markets, there can be only one real risk-free rate globally. Do you see why? Because if I told you the real risk-free rate in the US is 0.4% and in Europe is 0.9%, and capital can move freely, what's going to happen? It's going to leave the US, the rates are low, go to Europe until the rates converge. Now we know we don't live in a world with free capital markets, but I'm giving you an escape hatch. You're valuing a Brazilian company in real terms. Latin America, this is the part of the world where you see real valuation show up the most because inflation has burnt them so much in the past. They don't want to deal with inflation. I understand. You're doing a real valuation of a Brazilian company. You're looking for a real risk-free rate. I gave you a cop-out. Just use the TIPS rate as your real risk-free rate. You say, but it's a US rate. There is no currency attached to a real rate. It is what it is. And that then becomes your risk-free rate if you're doing things in real terms. But if you have significant capital constraints, you could end up with a rate that's too low for many emerging markets. But my suggestion then is don't do things in real terms. If it's difficult or really difficult to get a real risk-free rate, why are you even going down this path? Any questions on real risk-free rates? So let's summarize where we are. If you are looking at a currency where there is no default-free entity, right? The US dollar, the euro, there was a default-free entity. There's no default-free entity. You have three choices. First is you could start with a government bond rate and net out the default spread like I did for Brazil. The second is you can do everything in real terms, but then you need a real risk-free rate. You know what the third choice is? Let's say you're valuing a company in the Ivory Coast. You spend 2 weeks trying to come up with a risk-free rate. I don't even know what the currency in the Ivory Coast is, and you're getting nowhere. There's no government bond, and there's a way out. You can value any company in any currency. You can just value a company in US dollars. Of course, you then have to be consistent and make sure that everything you build in is in dollar terms. But now you can see why, again, if you use Latin America as an example, why so much capital budgeting and valuation in Latin America is done in US dollar terms. In fact, when I've been going to Brazil every year since 1997. I remember the first year I went to Brazil, not a single person, there was an audience of 200 Brazilian analysts, not a single analyst in that room did a valuation in nominal reais. They wouldn't even try it. They said, no, too risky. They either did in US dollars or they did in real terms because they basically lost faith in their local currency. Ask you a question. If I put in Caracas, first, that's not the place you want to be posted, but let's say I posted here, yeah, and I asked you to value Venezuela, would you really want to value a company in Venezuelan Bolivar? I mean, can you imagine trying to get a risk-free rate in Bolivar? You'd be spending the rest of your life trying to get a risk-free rate. Forget about valuing companies. So let's say I do the dirty work for you. I take those government bonds, I do what I did with the Brazilian bond, and I come up with a risk-free rate in multiple currencies. So this is a graph where the blue portion of the graph is the risk-free rate. The red is the default spread I've taken out. So you can see it ranges from negative risk-free rates in euros and all the way to really high risk-free rates in Zambia and Kwacha. We've kind of answered this question, but let's make sure we get it nailed down. Once you've cleaned up government bonds for default risk, what's the biggest variable driving differences in risk-free rates? Shreya?
It'll be
You cleaned up for
the
default
bank
risk. So you got,
yeah,
what's the biggest factor causing why some rates are high and others are low?
it's the bank rate at which the government can
But what drives
set.
that bank rate, right?
um
Because governments could control it. No government would want to have 30% rates. So obviously it's not entirely in their control, because you need people buying the bond at that rate. You can set whatever rate you want. Its difference is in inflation. High inflation currencies have high risk-free rates. Low inflation currencies have low risk-free rates. And deflationary currencies could have what, Matthew Center? If I have a deflationary currency, what could happen to my risk-free rate?
I'm not sure. Would it be especially low?
Or if it's deflationary, you could have negative risk-free rates, right? So there is the answer to the question. When people say, how can risk-free rates be negative? I wrote a piece on this a while back. I said it's uncommon, but it's not unnatural. There are some people who think of negative risk-free rates. That can't happen. It can. It doesn't happen very often, but it can. And we're in a world now where it does happen with some currencies. You say, what if I don't have a government bond rate? Then what do I do? There are lots of currencies where there is no government bond rate. 100 currencies probably. Now let's suppose, for instance, you're looking at an Egyptian company and you want to value an Egyptian company in Egyptian pounds. There is no 10-year government bond rate in Egyptian pounds. The question, what do I do in those countries? I'll give you a very simple way in which you can get a risk-free rate in pretty much any currency. And it's building on what we just talked about. What do we say causes difference in rates? Differences in inflation, right? So let's say the risk-free rate in US dollars now is 1%. The inflation in the US is 0.5%. You with me so far? Andrew Taylor, you're going to be my guinea pig. So I have a risk-free rate of 1% in US dollars. My inflation is 0.5%. I want a risk-free rate in Egyptian pounds. And I tell you, look, the Egyptian pound inflation is about 12.5%. Can you give me a rough estimate of what the risk-free rate will be in Egyptian pounds, given what I've told you?
Is it about, I actually don't know.
Let's back up. What's my risk-free rate in dollars? 1%, right? What's my inflation rate in dollars? 0.5%. My inflation rate in pounds is 12.5%. So what's the differential inflation? How much higher is the inflation in pounds than in dollars? It's about 12% higher, right?
Mhm.
Here's all you need to do. Take the 1% risk-free rate in dollars, add the 12%, that extra inflation, you now have a risk-free rate in pounds. And with that opening, you can get a risk-free rate in any currency. So if your inflation is 5,000%, in the Venezuelan bolivar, it's in thousands of percent, what's your risk-free rate going to look like? A really, really, really high number, which is higher than 5,000%. You can get a risk-free rate in any currency if you're willing to estimate inflation. I'll send you a link in today's email to the IMF actually gives you expected inflation in 180 countries. I don't know how good the estimates are, but you can actually use the inflation to back out what the risk-free rate should be in any currency. So any questions about that process? If you cannot find a risk-free rate, just take a US dollar or euro risk-free rate, add the differential inflation, to be able to get a risk-free rate in any currency. So let's complete this process. As I said, risk-free rates right now are low, 0.93%. And we all have a sense of normal. This looks abnormally low. You know, it just looks way too low. And I'm an analyst valuing a company. Airbnb this week, right? Value the company. My risk-free rate was 1%. Part of me was screaming, but the rate could be much higher. It could be 3, it could be 4. So let me ask you a question about what you would do given this discomfort that you're feeling with the risk-free rate being low. One is you can replace the current rate with a normalized rate, 3, 4, 5%, and leave everything else alone. The second is you can leave, let's stay with that. If I hold everything else fixed, Hakan, let's suppose I take a valuation of Airbnb, the valuation that I sent you. I leave everything else fixed and I change the 1% risk-free rate to 4%. What's going to happen to my value if I leave everything else fixed? My discount rate is going to go up. My value is going to go down, right? Let's say it goes down below the price. Let's suppose Airbnb looked undervalued before I did this. It now looks overvalued. You decide not to buy Airbnb. What are you going to do? Where are you going to put your money? Because in your valuation, what have you implicitly assumed? That you can actually find a place to put your money and earn a 4% risk-free rate. Good luck with that. You've got to live in the world you're in, not the world you wished you were in. And when I see people normalizing risk-free rates like it's going out of style, my question is, what alternate universe do you operate in where you can find these 4.5% risk-free rates? You think, but I still feel uncomfortable. I'll give you a way to deal with that discomfort where you don't have to make this assumption of replacing today's risk-free rate. Remember, you're doing a valuation of 10 years of forecast, right? And with the T-bond rate, you've locked in the risk-free rate for the next 10 years. Then you get to the end of year 10, your company keeps going and going. And you now have to re-up. You've got to figure out a discount rate after year 10. You see where I'm going? You're not stuck with today's T-bond rate 10 years out because there's going to be a market out there. If you feel rates are going to be 3%, that's your steady state. Don't replace today's risk-free rate with 3%. Replace the risk-free rate 10 years out with 3%. That's going to push up your discount rate and your terminal value. But that 3% also brings in views about growth and inflation that are different from today's numbers, which will affect your terminal value. In fact, if you look at my DCF models for both Airbnb, and I didn't take advantage of this, I might have actually, I took advantage of this option and never mentioned it to you. One of the questions I ask you is, do you want me to replace the risk-free rate after year 10 with a higher number? And I think I use 2% instead of the 1% today. And what I do then is raise the discount rate. That way you're not making up this artificial risk-free rate because that's not there. But you're essentially saying the world could change and I'm going to bring it into my valuation. Any questions about normalizing? Because this is a practice that actually has become very common in valuation. It troubles me a great deal because people just replace the risk-free rate with whatever they want, which kind of undercuts the whole point about valuing companies and thinking about opportunity costs.
I have a question.
Go ahead.
If I wanted to get more familiar with the relationships between risk-free rate and how it affects, terminal values, discount rates, just the relationships between them, what should I?
Very simple, right? Inflation. So if you look at the terminal value equation, there are only 3 numbers. There's your cash flow in year 11, there's a discount rate and a growth rate. The growth rate is a nominal growth rate, the discount rate is a nominal discount rate. If you live in a world with low inflation, your discount rates will be lower and so will your growth. So if you leave the risk-free rate at 0.9%, when you get to your terminal value, I'm going to say, look, I know you'd want a higher growth rate, but I'm going to give you a growth rate of only 0.9%. In fact, I cap the growth rate at the risk-free rate precisely for that reason. And if you raise the risk-free rate, very simply just raise the growth rate. That's why the effect on value is a lot smaller than you think. People think that if interest rates change, the value is going to kind of implode on them. But interest rates change for a reason. And if you build that reason into your valuation, the effects will not be as drastic. So let's talk about the Fed and T-bond rates. As you've heard, undoubtedly, the Fed's what's kept rates low for the last decade. Really? Is that the reason? So to test out whether this was the reason, I actually did a very simple comparison. If inflation is what drives your risk-free rate, I could compute kind of an intrinsic risk-free rate each year by taking inflation plus real growth. In other words, every year I took the inflation rate plus real GDP. So if you look at this graph, I have inflation plus real GDP. So if your inflation rate is 2% and your real GDP grows at 3%, 2 plus 3 is 5%. I call that an intrinsic risk-free rate. So if you live in a world with lots of inflation and lots of growth, you'll have a higher rate. So you can see this graph, I've compared two things. One is that intrinsic risk-free rate to the actual T-bond rate. I don't want to insult you by asking this question, but I'm going to ask it to you anyway. Do the two look like they move together? Of course. When inflation is low and real growth is low, risk-free rates tend to be low. When inflation is high and real growth is high, risk-free rates tend to be high. So let me reframe the question. Leah, I'm going to ask you this question. Why have T-bond rates been so low for the last 10 years? You can use the graph to tell me. You're still muted, so you got to unmute yourself. Okay.
Sorry, why have T-bond rates been low for the last 10
years? For the last
years?
decade, for the last 10 years?
It could be actually driven by GDP growth as opposed to the...
In fact, there it is. It's if you have low inflation and low real growth, as we have for the last 10 years, low plus low is low. Could the Fed have an effect? Yes, at the margin, it could have an effect. The biggest reason rates have been low for the last decade is we're in a world with low inflation and low growth. You're going to have low risk-free rates. You know, one of the biggest problems I have with some of the stories I hear about what the market will do for the rest of the year is, and you've heard this too, which is economic growth is going to come roaring back. And inflation might come back with it. But risk-free rates will stay low. No, you can't have your cake and eat it too. If growth is coming back and inflation is coming back, rates are going to go up, but Jerome Powell will stop it from happening. Who do you think Jerome Powell is? He's not God. He can't sit there and say, I'm going to keep the rates at 1%. If inflation goes to 4%, I don't care what the Fed thinks, rates are going to rise. Because you're not going to buy a bond with a 1% rate if inflation is 4%. Who is going to be the buyer of these bonds? So I know I'm fighting against the prevailing wisdom now, which is the Fed can do whatever it wants. I'm saying if that were true, we would never have high interest rates. How would you explain the 1970s when T-bond rates went to 10%? The Fed was just as powerful then.
They do control money supply, and that then affects inflation, which indirectly affects the...
Absolutely, that is the effect, and that's a long-term effect through inflation. But when people talk about the Fed having power, you know, they make the exact opposite argument. How do they keep rates low, at least in the story? They print as much money as they want, they keep rates low. The reason the story doesn't make sense is if they're actually printing money to keep rates low, it's going to show up as higher inflation, which means it's going to, there is no way out of this box. They do affect inflation through their control of the money supply. But that's not the tool people are talking about. The tool they're talking about is what the FOMC gives as its mission for the future. And to me, that the test will be, and the reason the Fed's been able to get away with this illusion of power is we haven't dealt with inflation for most of the last decade. If inflation comes back, and there is a story you can tell, then we're going to see how much power the Fed actually has to drive rates, because inflation is going to drive rates to whatever they need to be.
Professor, I have a quick question. Just could you argue that because of what the Fed has done with monetary stimulus, they've managed to produce real GDP, and if had they not done what they've done, the inflation might have been negative, and so the real GDP has been negative?
Well, I mean, I think that when you have, especially during crises, there's an argument that the Fed has a lot more buffer to do whatever it wants to do, right? And this is true for fiscal stimulus as well. Is the reason you could have a $1.5 trillion relief package and not have an effect on inflation is if you have excess capacity in the economy, you can have this kind of be the buffer. But if the answer to growth is I just need to pass a $2 trillion package every 6 months, it'll be growing forever, right? Just pass another package. The only problem is once you get closer to capacity, you're then going to see, as Yossi pointed out, the effects on inflation. For much of the last decade, we've been operating, and this came from the 2008 crisis, with buffer in the economy. And you could argue 2020 has created a buffer. There'll be a period where you can keep spending money, either as the government or keep printing money as the Fed, and not see the effects on inflation. But as you get closer to capacity, you can't escape it. It's one of the realities, which is you print too much money chasing too few goods, will create inflation. I'm not making predictions of inflation, but I'm just saying, look, you cannot tell me a story of great growth and inflationary pressures and also tell me in the same breath that rates are going to stay at 1%. Which brings me to the, yeah, go ahead.
Sorry, I just have a follow-up on that. So you're
Yeah.
saying essentially that if the Fed, let's say they were to manipulate the rates in a direction that the market wasn't headed.
But when you say manipulate, they can set the Fed
set
funds
the
rate.
But basically what you're saying is that people won't buy the bonds if they're not priced appropriately, and then it will be forced to readjust.
Exactly. Right.
Okay.
And in fact, the Fed doesn't even set the T-bond rate. It sets a Fed funds rate and hopes and prays that the signals it's sending affect it. You know what? If you look at the last 10 years, the signals the Fed sends are actually a lot weaker than people think they are. Right? Fed announces we're going to keep rates low, but then in the next few months, in fact, in the last 6 weeks, what's happened to T-bond rates? Started at 0.93%. It's now putting up to 1.15. You're seeing the 30-year bond rate crossed 2% yesterday. That's actually good news in terms of the economy, right? Because it means the market is building in an expectation of growth. But it basically also tells you how much that drives rates, not what the Fed might or might not say.
Professor?
Yes.
Can you argue that this whole money supply or printing money goes to financial assets, which is the reason that doesn't drive up inflation? So it goes to the stock market. So all the money that's been printed goes to the stock marcket. So it doesn't necessarily mean that's going to drive up inflation.
But remember, Yossi, it doesn't stay in the stock market. If my stocks go up, do I feel richer? Yes. Do I feel richer? What do I do? I mean, there's almost no story you can tell. You can tell a story that it's basically maybe the rich, that this is something where you can argue that maybe the top 20%.
No, because today you have retail investors. You have a new asset class of retail investors who are putting money in the stock market, which is a new phenomenon. So that can be a buffer to inflation because this money just goes out from the.
But what about fiscal stimulus? Because that's clearly not going just into the market, it's going into people's pockets. So I'm saying there are a bunch of things at play here, which the Fed doesn't control, right? If everybody gets another $1,400, I mean, clearly they're going to spend money. And to the extent that there's excess capacity, you can get away with them spending money. But how are you going to get economic growth from that spending without creating at least some pressure on prices at some point in time? So we'll see, right? This is going to be an experiment we're going to watch. We're going to see this in the next 4 months. This is not an abstraction. If the economy comes back strongly, my prediction is you're going to see rates move from 1.15% closer to 2%. If the economy turns out to be, that's my prior. If the economy turns out to be weaker than expected, the shutdown lasts longer, rates are going to stay low, but so is the growth. So if you're looking for this Goldilocks effect of I'm going to do it at the high growth, but I want to keep rates low, it could happen. But I think that's something we're going to see play out in the next 3.5 to 4 months is what happens to rates and what happens to growth and how the economy, they're all connected. You can't just talk about one without talking about the other. One final point on risk-free rates. We said, interest rates risk-free rates can get negative, and you saw it with the Japanese yen, the Swiss franc, and the euro. Especially, this has been true for 4 years. Okay. And if you think about explaining it, we've kind of seen the reason. The reason rates often get negative is because people get pessimistic. When people are, what do negative interest rates tell you? They're bad news for me. From a valuation perspective, I'd much rather live in a world with positive interest rates than negative interest rates. Because negative interest rates are a signal to me that, at least in this part of the world, the future does not look good. And in case you're wondering whether this is new, the Japanese have been dealing with this for 30 years, right? Rates that are much lower than the rest of the world, often flirting with negative values. And it's not been good news for the Japanese economy. It's a reflection of the aging of Japan as a country, the slowing down of growth. So when people just move interest rates around, it drives me crazy because they say lower risk-free rates are better than higher risk-free rates. Well, if I could keep everything else constant, but if you think about everything that goes into low risk-free rates, I'd much rather trade in a world of 1% risk-free rates for a world with 3% risk-free rates. With everything that goes with 3% rates. To me, that will be the sign the US economy is back to strength, is when the T-bond rate's 2.5%, 3%. And it doesn't mean stock price will have to collapse, because that will mean that growth has come back, earnings are coming back. It's a good sign rather than a bad sign. So that's the risk-free rate. Any questions on the risk-free rate before we put this topic to rest? It's becoming, 30 years ago, I'd have spent 5 minutes on risk-free rates. When I did my MBA, we spent, I think, 10 seconds on risk-free rates. I was told to use the 10-year Treasury rate as my risk-free rate, and we moved on. So it shows you how dollar-centric my MBA was. But risk-free rates have become this kind of controversial issue. And you don't have to agree with me, but just go through the data before you decide that the force is driving rates or any story here about interest rates. Which brings me to my second input, an equity risk premium. The equity risk premium is the premium I charge over and above the risk-free rate for investing in equities, collectively. Think about what I just said. It's what I charge over and above the risk-free rate. Now, the problem with the equity risk premium is, unlike a T-bond rate, you can't observe it. It's you don't know what it is. You don't know what people have in their heads when they buy stocks. So you know how most people estimate equity risk premiums? They look at the past. And they do what they ask, what would have made investing in stocks as opposed to treasuries over the last 20 years, the last 50 years, the last 75 years? It's called a historical equity risk premium. You might remember this table from corporate finance, but these are historical equity risk premiums for the US going back to 1928. Take a look at the table. If you ask me what the historical equity risk premium for the US, I'm going to come back with a slippery answer. I'm going to say it's somewhere between 3.9 and 13.8%. Fat lot of good that does you, right? You're saying, how can they all be historical risk premiums? Because it depends on what slice of history I look at. You can tell me how far back you wanted to go. It depends on whether you use T-bills or T-bonds as my risk-free rate. It even depends on how I compute my average, whether I take an arithmetic average, 80 years divided by 80, or a compounded average. 90% of people who do valuation use historical equity risk premiums. In fact, if any of you worked in the appraisal business, it used to be that Ibbotson was the service that provided this, but Duff & Phelps publishes this 300-page of historical risk premium. You could slice and dice the data. But I'm going to say something about every number in this table. I don't trust a single number further than I can throw it, because every single number on this table is an estimate. Why? Because I'm taking 80 years of data, I'm coming up with a number, it comes with a standard error. Remember in statistics, when you report an estimate, you're forced to report in brackets below how uncertain you feel about a very, very good practice that we completely forget after statistics. See the 2.18% in red? That's the standard error on my historical risk premium. We go all the way back to 1928. And the shorter the period, the bigger the risk premium becomes, the standard error becomes. So essentially what you get is a range on the risk premium, which in my view is so wide that it's completely useless. Let me explain. If I go all the way back to 1928 and I tell you that the historical risk premium stocks over bonds is 4.84%, it's false precision, I threw in a second decimal point. You know what I'm not telling you? Remember, in statistics, it's plus or minus 2 standard errors. The true equity risk premium for the US, even with that number, is somewhere between less than 1% and greater than 9%. That's with almost 100 years of data. If 10 years of data, all you have is noise. So telling me what stocks have done over the last 10 years does not help me even come up with the risk premium, because the noise is so large. So for 3 decades, I've struggled with what to do about it, because these estimates are noisy. There's a selection bias. This is the US market, most successful market of the 20th century. One way out might be to look at other markets and look at their historical risk premiums. In fact, Credit Suisse has this great book on historical risk premiums that London Business School publishes, where they report, where the researchers actually report historical premiums over 100 years for almost 21 markets, not just the US. But it's still backward looking. It still has that standard error. So I've tried everything I can with historical premiums, and I don't see a way out. There's no good way of estimating a forward-looking equity risk premium by looking backwards. And to add to all of this, to the extent that the global economy itself has shifted, we might be in really dangerous ground looking backwards when the world is shifting under us. But for the moment, let's stay with that historical risk premium. I'll give you an alternative in a little while and talk about how you can build off that historical risk premium to come up with an equity risk premium for other countries. Because remember, in many countries, you don't have this luxury of going back 100 years, right? If I gave you Vietnam and said, what's the historical equity risk premium in Vietnam? You could scrape all the data you can, but if you'd be lucky to get 4 years of data. Even markets like Germany, because of the break in the Second World War, end up with like 75 years of data. You're saying, what do I do then? I'll give you a couple of ways in which you can come up with an equity risk premium for a country. You could start the equity risk premium for the US. Let's say for all its weaknesses, you say, okay, this is my 4.84% is my base premium. That is my premium for the US. Remember that default spread we just used to get to a risk-free rate? What was it for Brazil? 1.95, 2%, somewhere around there. I can take my risk premium for the US, 4.84%, and add the defaults for Brazil right on top of it. It's a very sloppy, simplistic way of doing things. But it is, in fact, the default way in which most investment banks get equity risk premium for other countries. They take the US equity risk premium, often based on historical data, and they add a default spread based on the CDS market or the rating on top of that. 4.84 plus 2% gives me an equity risk premium for Brazil of 6.84%. I'm going to stick with that simplistic approach, but I'm going to add a tweak to it. But with that approach, basically what you have is the equity risk premium for the US plus the default spread for the country. So if you're in a country with zero default risk, you'd use the US equity risk premium. Let me pause and make sure I'm with you. So basically, the first approach, you add the default spread for the country onto the equity risk premium for the US. Here's the second approach, and it's an approach I think Goldman came up with about 25 years ago. They said, look, if I know the equity risk premium for the US, I can estimate an equity risk premium for an emerging market if you give me two numbers. The first is the standard deviation of equities in the US, maybe the S&P 500. The second is the standard deviation of equities in whichever market you look at, Brazil, Bovespa. So let's take an example. Let's suppose the equity risk premium for the US is 4.72%. Let's say the standard deviation in the Bovespa is 30%, and the standard deviation in the S&P 500 is 18%. Ready? I'm going to set up an algebra problem. If you invest in the US with a standard deviation of 18%, you're demanding a 4.72% risk premium, right? But let's say you're interested in investing in Brazil, which has a standard deviation of 30%. What should your equity risk premium be? Simple algebra problem, right? You take the 4.72%, you scale it up for the fact that Brazil is riskier than the US, 30 over 80. You come up with an equity risk premium of 7.18%, 7.89%. You see what I've done? I've taken the standard deviations and scaled it up and effectively come up with a risk premium. When I first saw this, I said, this is great, let me try it out. And I realized very quickly that it came with a very serious problem. You know what the standard deviation in the Egyptian equity market is? It's very, very low. It's like 5%. You know why it's so low? It's not because Egyptian equities are not risky. What is it that drives the standard deviation you see in prices? In addition to the underlying risk, what has to happen to show up in standard deviation?
Fluctuation. And
for the fluctuation to show up, there's got to be trading, right? Let's take the extreme case. Let's suppose you have a market which is extraordinarily illiquid. What are the stock price of most stocks going to be in that market on a day after day after day basis? Nothing will happen, nothing will happen, nothing will happen, nothing will happen. Lots of things will happen on the fifth day. The standard deviation of illiquid markets is going to be very low. And if I use this approach, you know what equity risk premium I'm going to give for Egyptian stocks? A tiny, it looks safe to me. You know what? There's no standard deviation. If I then value Egyptian stocks using that equity risk premium, I'm playing with dynamite. So if you know, if you're interested, I'll send you a link to a paper. I have an equity risk premium. I have these standard deviations for every Latin American market. And there are a couple of Latin American markets like Costa Rica where the liquidity is so low that my standard deviation is 1/3 what it is in the US. I end up with these really, really low equity risk premiums. So if you look at the first approach, default spread, that strikes me as a bludgeon approach. The second approach is relative equity volatility. The Goldman approach doesn't work if I have an illiquid market. And the markets I'm most worried about in terms of country equity risk premiums are markets that are often illiquid. Which leaves me with my third choice. And again, you don't have to buy into this. You can replace with your own. Here's what I do. I take the first approach and I add a layer to it. My biggest problem with that first approach, where I took the default spread and added it onto the US equity risk premium, is we're assuming that the default spread, which comes from looking at government bonds issued by that country, are roughly the same risk as equities in that country. In other words, a Brazilian government bond and Brazilian equities are equally risky. And I'm making that assumption on country after country. It's a little dangerous, right? Equities are usually riskier than the government bond. And if I can somehow tell you how much riskier, maybe you can adjust your default spread for that risk. Okay, let me not be abstract. If you remember, the default spread for Brazil I got based on the rating was 2.65%. Let's say the standard deviation in the Bovespa, the Brazilian equity index, is 30%, and the standard deviation in the Brazilian government bond that gave me the default spread is 20%. So Brazilian equities are roughly 1.5 times more volatile than Brazilian government bonds. Again, algebra problem. 2.65% is the spread for a Brazilian government bond. 1.5 times that is 3.98%. That then becomes my equity risk premium for Brazil. So let's review. You can add the default spread to the US premium. You can take the US premium and scale it up for the relative volatilities of the two equity indices, or you can take this melded approach where you take the default spread, adjust for the fact that equities are riskier than government bonds, and add that on to your US premium to come up with an equity risk premium for a country. I've been doing this now, I think the first year that I actually did it was 1992. Where I estimated equity risk. So this approach, I mean, basically there's nothing, no rocket science here. And I'm pretty transparent about everything I do. And I've been doing it, as I said, at the start of every year for 30 years, in the middle of every year for most of the last 30 years. Last year, I actually did it again, not just once, but twice in the middle of the year because the crisis was out there. So I'll give you an update on what the numbers look like for my January 1st, 2021 update. I needed an equity risk premium for the US, and I'm going to give you the way I got the 4.72%, my base premium. Didn't come from historical data. It was an implied premium based on the future. That was my starting point. 4.72% is my premium for the S&P 500. I took that premium and made it the premium for every mature market in the world. And already we're treading on dangerous ground. You're saying, how the heck did you decide which markets were mature? I cheated. If your country was AAA rated, I assumed you were a mature market. I gave you the US premium. So you can already see the countries that are going to end up with 4.72% premiums: Germany, Australia, Singapore, Netherlands, AAA rated countries. If you're not AAA rated, then I did what I did with earlier, which is I looked up the default spread for that rating, Baa3, whatever the rating is. I came up with the default spread for your country. Now I could go look up the equity index volatility and government bond volatility in every country, but it's a dead end in many countries because most countries don't have government bonds, and those that do, the government bonds are not very liquid. So I apply what I think of as a bludgeon. I look up two standard deviations, one in an S&P emerging market equity index. So you can find this on the S&P website. It's an emerging market equity index. I look up the standard deviation of that. And then S&P has another index of government bonds in emerging markets. You see where I'm going to go? I look at the ratio of those two standard deviations, And that ratio at the start of 2021 was about 1.1, which means if your default spread is 3%, I'm going to multiply the 3% by 1.1 to come up with 3.3%. Yeah, that's the 4.72. I have an equity risk premium for your country. So here's what the world looked like to me at the start of 2021. I've tried to break countries down geographically. I've actually screwed up on one country. I'll ask you to find the country, but they'll be looking a needle in the haystack. I made the mistake of putting Mauritius in Asia. It's actually in Africa. I find the minute I screw up, I hear from, this is the most downloaded data set by far on my website, by far. And basically what I'm here is the rating for the country. So you'll notice that any AAA rated country has 4.72% as a premium. There's no additional country risk premium. And any country that doesn't have a AAA rating has a country risk premium and a much larger equity risk premium than the US. But to do this, I do need a rating. There are countries which don't have a rating. These are called frontier markets. And you can very quickly see why they don't have a rating. North Korea does not have a rating. You know why? Let's say you go to work at Moody's and you're given an assignment. You know what? When we decide to cover North Korea, you're flying out to North Korea tomorrow to do the assessment. I would suggest resigning right then because you're not coming back. These are countries that are so dicey that the rating agencies throw up their hands and look, Libya, Sudan, we don't have a rating. And for a long time, I used to ignore them. But let's face it, you have companies that operate in Libya, in Iraq, maybe even in North Korea. I don't think North Korea, but maybe even in North Korea, which means I need to come up with a risk premium. So for the last 4 or 5 years, I've used a kind of cheating mechanism. There's a service in Europe called Political Risk Services. They come up with a numerical score for a country, and they do it for North Korea, Sudan, Libya, etc. The lower the score, the riskier the country. So to give you a sense of how it works, their safest country last year, I think, was the Netherlands. 94 was the score. The riskiest country might have been the South Sudan or something, 26. Here's what I do. I take these countries, I find their risk score on PRS. Then I find other countries with a similar risk score. So let's say your risk score is 37. I find countries with risk scores between 35 and 40, which have a rating. Then I take whatever the country risk premium I come up with for those countries and attach it to yours. You think that is so unsophisticated. Guilty as charged. If you can find a better way of attaching a country risk premium for North Korea, I'd love to hear it. But at the end of this process, there's the world in front of you. And you know what? You need this entire picture to be able to value pretty much any company. You see, what if I value Coca-Cola? Especially if you value Coca-Cola. It's a US company in terms of incorporation, but where does it get its revenues? All over the world. You pick almost any high-profile company, you're going to find that its revenues come from all over the world. And to estimate the equity risk for this company, you need to have this picture. Any final questions before, or no, that is going to be my last slide. Any about these equity risk premiums? What's its weakest link with this approach? I've been doing this for 30, I've thought through every weakest link and tried to, because I want a good, I'm not stuck on this approach. I want the best equity. What's the weakest link? What's my starting point for country risk? A rating, right? Which is based on default risk. Let me ask you a generic question. In addition to all the mistakes ratings agencies make, are there parts of the world where default risk is low, but there's actually a lot of country risk? Take a look at the Middle East. What do you see? A lot of low equity risk premiums, right? You look at Saudi Arabia, you get a low equity risk premium. Why? Because there's not a whole lot of default risk in Saudi Arabia. It uses its oil money, it doesn't have a lot of debt. The problem with a default risk view of country risk is it might miss other risks. With Saudi Arabia, it could be regime change, it could be whatever, oil connected to oil. Those things are not showing up in my. So every year I keep asking, can I do something that gives me a more complete measure of risk? I still haven't found something that works for, I can find it for a subset of countries, maybe 15, but I want something that works on 170 countries. And so far, I've had not much luck doing it. But that doesn't mean you couldn't come up with a creative way of doing it, because I need this number to be able to value most companies that have revenues from multiple countries. Any questions? Okay, I'm going to sign off and I will see you on Monday. So make sure you pick a company, please, and start your evaluation process because the train's leaving the station.
Professor, do we have class on Monday? It's President's Day.
Oh, that's right. I forgot. You're right. There's no class on Monday, next Wednesday. So you have a whole week to catch up on your project. Okay. Take care.